June 30 is closing in, and if you own an investment property, this is the number that should grab your attention. On a worked example, a typical Brisbane investor could be missing around $14,500 in legitimate deductions every single year. That is real money you could be handing back in tax for no reason. Here is what is happening. The 2025 to 26 income year ends on the 30th of June, and the ATO allows you to deduct most expenses incurred while your property is rented or genuinely available for rent. The problem is most investors only claim the big obvious items like interest and rates, and quietly underclaim everything else. Why does this matter so much? Because deductions are not just loan interest and council rates, which is the myth most landlords believe. The ATO permits a whole range of running costs plus two powerful non-cash deductions in capital works and depreciation, and together those can roughly double your total claim compared with just the basics. Picture Lisa, a 42-year-old marketing manager on $110,000. She owns a $600,000 unit in Brisbane bought in 2018, paying $30,000 a year in interest on an interest-only loan. On a 37% marginal rate, every dollar she fails to claim costs her 37 cents in tax. Here is the single sharpest number to remember. If your building was constructed after the 16th of September 1987, you can claim 2.5% of the qualifying construction cost every year for up to 40 years. Yet many owners claim zero because they never got a depreciation schedule. Now the catch buried in the rules. Since budget night on the 9th of May 2017, if you're not the original purchaser, you generally cannot claim depreciation on second-hand plant and equipment installed by a previous owner. You can only depreciate the assets you buy yourself, like a new oven or air conditioner, while still claiming capital works on the building. So here is exactly what to do now. First, log into MyGov and audit every rental expense in the ATO rental schedule against your bank statements, not just interest and rates. Second, use the ATO depreciation and capital allowance tool to capture your building write-off and any new assets. Third, prepay up to 12 months of landlord insurance or management fees before the 30th of June so it is fully deductible this year. Mark this deadline. Any prepayment you want to claim this year must be made before the 30th of June, and it has to cover 12 months or less, ending on or before the 30th of June 2027. Get it in on time and it is fully deductible right now instead of spread over years. And here is what is next. For Lisa, claiming the full $14,500 in deductions cuts her tax by roughly $5,365 a year. That is simply her deductions times a 37% marginal rate. Over 23 years to retirement, that adds up to around $123,000 in tax saved. Treat these as illustrative figures based on her own tax rate, not official ATO estimates. The 30th of June does not wait, and neither should you. Subscribe to the fine print and we will keep you across every tax change, deadline and deduction that affects your property and your money. Get the schedule sorted, run the checklist, and stop handing the ATO more than you owe.